Hello and welcome to the Roundup. We'll take you through what was important to accountants and advisors across the month of June. This month we'll bring you an overview of the new financial year changes and what you need to be doing. But first up, Michael Carruthers is going to take you through the new guidance from the ATO on Section 100A. Now Michael, before we get started, can you just give us an overview of Section 100A and what the issues actually are?
Yeah, Section 100A is basically an integrity provision that relates to trust distributions. And effectively what Section 100A is really designed to do is to make sure that when a trustee appoints income to a particular beneficiary, the real benefit of those funds is enjoyed by that beneficiary and not by someone else. And so Section 100A is really aimed at situations where income might be appointed to person A, but the real benefit of those funds is actually given to person B or entity B. And when Section 100A is triggered, effectively what happens is that rather than person A being taxed on that relevant share of the taxable income of the trust, the trustee is taxed. So not the person who actually gets the benefit, it's basically treated as income to which no beneficiary is presently entitled. The trustee gets taxed on that relevant share of the taxable income of the trust, and that happens at penalty rates. And so what it means is that that attempt to appoint income to a certain beneficiary who may well be on a relatively low marginal tax rate often won't be effective when Section 100A is triggered.
I've noticed that the ATO's released some new guidance on Section 100A. Does this new guidance provide any clarity for practitioners?
Yeah, look, we were told that the ATO's new material would basically make things a little bit easier for people to understand and would hopefully give some more comfort to people to, I guess, to reduce the stress levels on accountants and clients when it comes to some of this new material from the ATO. Now, from my reading of this new ATO guide, it doesn't necessarily say much new. What it does is effectively collates some of the material that's scattered across different documents at the moment and brings it together and tries to summarise it and in some ways simplify the position a little bit. So you won't necessarily find any brand new material in there. What you'll just see is a bit of a shortcut way of understanding the ATO's previous guidance. So earlier in the year, the ATO released a draft tax ruling, a draft practical compliance guideline, and a taxpayer alert. And the problem with that approach was that you had all these examples and scenarios spread across 3 different documents. That in itself made it quite difficult to understand what the ATO was really getting at. So the advantage of this newer website guidance material published by the ATO is that it brings some of the key concepts and examples from those 3 separate documents and puts them in one place. It's a much shorter document. It's the sort of thing that you can run your eye over and kind of read through quite quickly and hopefully get the gist of what the ATO is really worried about in a quicker and easier way. Now, there are a couple of examples in that guide. They're quite brief. You might argue that some of those examples are a little bit different to what's in some of the other guidance material, but really they replicate a lot of what's already out there. So I'm not sure this really changes anything. It's certainly not a game changer when it comes to dealing with trust distributions for the 2022 year or moving forward. But it is if you're struggling to understand what the ATO's concern is and maybe what you should be most worried about. Look, this isn't a bad starting point because it does distill some of that other guidance into, I guess, one place where you can kind of just get a bit of a feel for what the ATO is worried about.
So what are some of the key things and problem areas with Section 100A?
Yeah, look, since the ATO released that material earlier in the year, there's been a lot of confusion around what is it the ATO is worried about and how does Section 100A actually operate. And today isn't the time to run through every single issue that comes up under Section 100A, but there are some key things that are coming up over and over again where it's clear that practitioners and clients are either getting a bit confused or maybe not focusing on quite the right thing. So if we just go back a step and remember that Section 100A is all about income that's being appointed to a particular beneficiary and whether they ultimately receive the benefit of that income or those funds. Now, one of the first things to remember with Section 100A is there is a specific carve-out for income that's been appointed to a beneficiary who's under a legal disability. And the most common example of that would be a minor beneficiary. So if you have clients who are distributing income to minor beneficiaries, you don't need to worry about Section 100A for those particular distributions. They're just completely carved out from Section 100A. So you don't need to worry about 100A. There might be other things you need to consider, but that's not one of them. When it comes to beneficiaries who are not under a legal disability, again, remember the key issue is the person or the entity that's been appointed the income receiving the ultimate benefit of those funds. And we can distinguish between a couple of different scenarios, and the one that the ATO seems to be focusing a lot on in that original guidance from earlier in the year, but also this new guide that's been released over the last month, is situations where income is appointed to an adult child beneficiary, but they don't really receive the benefit of the funds. The funds are really used for the benefit of their parents or some other family member or entity within the group. Now, one of the examples from the taxpayer alert that's quite helpful here is showing that there are ways that people can potentially receive the benefit of distributions possibly in an indirect manner, and that can still be okay from the ATO's perspective. And so the example that the ATO looks at is where an adult child beneficiary who's attending university has their uni fees basically covered from the trust. The trust is paying or reimbursing them for those uni fees. That's an expense that the child is incurring personally. It's something that arose after they turned 18. And the ATO says that's an acceptable way of satisfying that obligation to pay that distribution to them. Other examples could be car expenses for that adult child. They might take a holiday with their friends. The trust could potentially pay or reimburse them for that expense. It could be board expenses, rent expenses, if they're staying close to where they're studying, that sort of thing. The key thing is, are they personally receiving the benefit, and does it relate to expenses they have incurred personally after they turned 18? If we're trying to allocate trust distributions against expenses that were really incurred by their parents, particularly expenses incurred by their parents before that adult child turned 18, that's where we potentially run into some problems, and that's high on the ATO's list of problem areas. The other thing that is, again, causing a little bit of confusion is I think people getting a bit worried about how quickly you need to satisfy that obligation to pay the distribution. We've had a lot of people ask us, does this mean that we have to physically pay out those distributions by 30 June each year? Look, the short answer to that is you probably don't, unless the trust deed says you have to. And in many cases, that wouldn't really be possible or practical because you won't necessarily even know the right number. But the longer that entitlement is left unpaid after year end, the higher the risk of Section 100A applying. What we really need to look at then is how are those funds being used while they're still being accumulated in the trust and haven't been paid out yet. And the ATO gives a couple of scenarios, situations where funds that have been appointed to a beneficiary, whether it's an individual or a company, are retained in the trust and used by the trust in its business or investment activities. And as long as certain conditions are satisfied, the ATO says that can be acceptable, and there's no specific time frame around that. But you do need to look at the detail of the ATO's examples and scenarios just to see whether you fall within the scope of those low risk categories. Now, again, where some of the confusion comes up at the moment, and there's not an easy answer to this, is what if your scenario looks reasonably similar to some of that ATO guidance, but it's not quite the same? What happens then? Well, I think at a practical level, it means you're probably in many cases ending up in a medium risk category. As long as the arrangement doesn't display any high risk features, and the ATO tells us what some of those things might be, you're probably in the middle somewhere. You're probably medium risk. The closer your scenario looks to the ATO's low risk scenarios, obviously the better that is in terms of coming down on that risk scale. So just a few things to keep in mind there. Again, a lot of confusion out there in terms of what this guidance means, how Section 100A actually applies in practice. It does mean we need to be aware of this, and we should be taking care, not only in terms of what's happened in the past, but also moving forward while we wait for further finalised ATO guidance. We do need to be careful in this area. The final thing I would say on this is, again, we've had a lot of people say to us, this new ATO guidance on Section 100A, does it mean we're not allowed to distribute to companies anymore, or we can't distribute to adult children anymore? Just remember, Section 100A isn't about whether you can appoint or allocate income to a beneficiary, it's whether they receive the benefit of it. So there's not necessarily any problem appointing income to a bucket company, for example, as long as you're dealing with the Division 7A issues that might arise from that, but also making sure that it's the company that ultimately benefits from that income. So these rules don't stop you distributing to a company, they just make sure that you're actually then giving the benefit of those funds to the company. So quite a few things to keep in mind, but hopefully that just helps in terms of clarifying some of the myths that are floating around at the moment around Section 100A.
Now across to Matthew with those incoming New Year changes.
So Matt, I've noticed ATO website material is suggesting that there are some changes coming in the tax system from 1 July 2022. Is there anything major that we should be really keeping tabs on at the moment?
Yeah, you're absolutely right, Mike. The ATO have released some updated website guidance that basically gives us a bit of a heads up on some of the new measures that are commencing in the next financial year. So from 1 July 2022 onwards. Look, the key measure, which I actually think has been quite controversial, is the ATO's finalised guidance on profit allocation for professional services firms, which was actually finalised this year. Now, we've discussed these guidelines a couple of times at length, but just to give you some overall context, the ATO is really targeting with these guidelines professional firms that operate through a business structure and that where they don't derive income from personal services. So they don't derive personal services income. Now, if they do derive personal services income, the rules are actually a bit more strict. But putting that aside, the ATO is more or less concerned with situations where income is from a structure, from a business structure, is being diverted to other related parties so that the individual principal practitioner ends up with less income and less tax than what the ATO would otherwise consider reasonable. Now, the new finalised guidelines are a bit more complex than the old previous guidelines, which were actually suspended a couple of years ago. The new guidelines require you to basically look at two gateway tests. So you do need to check that there is a commercial rationale for the client's structure, and you do need to check that there are no high risk factors at play. Now, if you can do that, then you would assess the client under either 2 or 3 benchmarks, depending on the client's circumstances, and basically they'd end up with a score that determines whether they're considered low risk, medium risk, or high risk under the guidelines. Now, compared with that to the old rules, the old rules or the old guidelines were much more simpler. It was a simple pass or fail, and the client would only need to pass only 1 of 3 benchmarks in order to be considered low risk. Now, look, all the ATO is really saying here is that the finalised guidelines apply from 1 July 2022 onwards, so from the 30 June 2023 income year. But you do need to be aware that there can be some transitional periods that can at least apply for some taxpayers. So clients with pre-existing arrangements that were considered low risk under the old previous guidelines can still rely on those guidelines at least until 30 June 2024. So it's not always going to be 1 July 2022 for all taxpayers. Some taxpayers may qualify for that transitional period. Now, if you haven't already, now would be a really good time to have that chat with your professional services clients and try and work out where they sit in terms of their risk rating. If you've got clients that are in that medium or high risk zone and they want to move towards a lower risk zone, then there's another conversation to be had around some of the things they can do to try and achieve that.
Apart from that, are there any other changes in the tax system that are going to be kicking off from 1 July 2022?
Yes, there are. The ATO has updated its website guidance to just give us a bit of a quick reminder on the changes to the employee share scheme rules. Now, not many of us are going to be dealing with employee share schemes on a regular or daily basis, so these changes are very easy to miss. Just to give you a bit of context and background, subject to some limited exceptions, the way it normally works is that if an employer provides shares or options to their employees at a discount, then that discount would normally be accessible to the employee either upfront or on a deferred basis. If the scheme does qualify for deferred tax treatment, then the taxing point should normally be the earliest of one of 3 or 4 deferred taxing points, whichever deferred taxing point happens to occur or happen first. Now, one of those deferred taxing points is when the employee leaves that employment. That historically has been seen to be a bit of a problematic taxing point. And that's because when an employee leaves their job, that could trigger a tax liability under the employee share scheme rules. But at the same time, there still might be restrictions, for example, from the employer, around their ability to dispose of the underlying shares or options. That creates a bit of a mismatch. And the issue there is that some taxpayers may not have the funds to fund that tax liability. Now look, if you're dealing with employee share schemes that are taxed on a deferred basis, all that's really changed is that there shouldn't be a taxing point just because an employee leaves that job, at least from 1 July 2022 onwards. Just something to really keep in mind, and just given that many of us don't deal with employee share schemes on a regular basis, very easy to miss.
I've noticed the ATO has updated its guidelines around expiring subtrust arrangements in the context of Division 7A. Hopefully this is the last time this happens. What is this area all about, and what does this mean in practical terms?
So yes, the ATO does have an existing practical compliance guide that deals with expiring subtrusts and how that works or interacts with Div 7A. Now, the compliance guide has just basically been updated to ensure that it applies to unpaid trust distributions arising on or before 30 June 2022. Now, just to give you a bit of a background, if a trust makes a distribution to a private company beneficiary and that distribution remains unpaid, now the ATO basically updated its guidance back in or around December 2009 to say that can and does cause Div 7A issues if certain conditions are met. Now, one of the ways to deal with that Div 7A issue is to enter into or put in place a complying subtrust arrangement. And one of these subtrust arrangements either involves a 7 or 10-year interest-only loan term. Now, at the end of that loan term, the trust must pay that principal balance out or back. If not, the ATO says that does create a loan from a Div 7A perspective. Now, the good news though is that if there is a loan from a Div 7A perspective, then the PCG or the Practical Compliance Guide does allow the parties to enter into a normal complying Div 7A loan agreement in order to avoid that deemed unfranked dividend from applying to that unpaid balance. Now, of course, once you enter into a complying loan agreement from a Div 7A perspective, you do need to ensure that minimum repayments of interest and principal are being made each year for the next 7 years. Otherwise, that can create another issue, another Div 7A issue on the repayment shortfall. I guess what I'm trying to say is that if you've got a trust that has an expiring subtrust arrangement, and they don't have sufficient funds to pay out that remaining principal amount, look, then just be aware that there is an alternative way, or there is a potential alternative way of dealing with this. This isn't new. The existing compliance guide, has been there. It's just that it technically didn't apply to subtrust arrangements expiring in the 30 June 2022 income year. Okay, that compliance guide has just been updated so that it will apply to unpaid trust distributions arising on or before 30 June 2022. So hopefully that will just settle matters once and for all.
And that's the roundup for this month, and happy new financial year. We hope the new incoming year is a fantastic one for you. If you're not a member of Knowledge Shop, the way you can make that new year even better for your team is to join as a member. You've got access to a work paper knowledge base of all the New Year standards, you've got the help desk, you've got quarterly PD and so much more. Just give the team a call and we'd love to show you what we're doing for thousands of accountants across the country every single day. Speak to you soon.